Hey, how are you? Hope all of you are well. It's your CPA Manish here today on Friday, the 6th of May, 2022. Hope you got a chance to watch my previous video on pension planning, tax strategy for all. In that video, we discussed about why people do pension planning, what are the reasons you must do that. We also discussed what are the situations where you might want to do Roth pension plan compared to the traditional one. We also discussed that you should try not to withdraw money before you are 59 and a half years old. And the fourth thing we discussed was the matching concept. Matching concept is where if the employee contributes, the employer contributes. If the employee doesn't contribute, the employer doesn't contribute, right? So with those things in mind, today, we are going to discuss the first set of pension plans. And this first set of pension plans are individual retirement plans, individual retirement accounts, or IRAs, as we know them. And this is for individuals. These are the pension plans that we put into place as individuals, not as employers. So this is what, as individuals, we put into place, okay? Before we move further, as I always say, the legal disclaimer, this video, all these videos are only for your education and entertainment purposes. Nothing here should be construed as any kind of tax or legal advice, okay? So with that, let's move forward. We are going to discuss 3 or 4 plans today, which we can put into place as individuals, as persons. The first plan that we can put into place is called traditional IRA. In this traditional IRA account, we can put every year up to $6,000. Based on this year, that is the year 2022, we can put in a maximum of $6,000. If you are 50 years or older, then you can put in additional $1,000 as catch-up. So instead of $6,000, if you're 50 or old, you can put $7,000 in a traditional IRA account. When I stress the word traditional, you know what traditional means. Traditional means that you will get a deduction for this contribution today. You will get a deduction for this contribution now when you put the money into the pension account. But then when this money grows for next so many years, and then when you withdraw this money in your retirement, at that time, you will have to pay tax on all those withdrawals. That is the definition of any traditional pension account, including this traditional IRA. Traditional just means that when you put the money now in your retirement, you do get a deduction on your taxes. But when this money grows and you withdraw these monies in your retirement, at that time, you will have to pay tax. That is what the traditional IRA means. There is no income limit as such. Anybody and everybody can put in money into traditional IRA. But up to a certain income limit, you get to take a deduction. And if your income exceeds those limits, then the contribution becomes non-deductible. So a higher picture is that there is no income limits. Everybody can put money into traditional IRA. There is no restriction. There is no income restriction. Everybody can put money into traditional IRA, but everybody cannot get a deduction for that. Until certain income limits, you do get to take deduction. If your income is beyond the limit, then you can do contribution to traditional IRA, but those contributions will be non-deductible contributions. You would not be able to take those deductions. Understand, your question would be, your curiosity would be, if I cannot take a deduction, then why would I do that? And give me a few minutes, I will come to that point. I'll explain to you that even if you do not get a deduction, many a times it makes sense for you to still do a non-deductible traditional IRA contribution. What are the circumstances where that makes sense? We'll discuss in a few minutes. So again, there is no limit. Everybody can put in money, but some people can get deduction. Not everybody can get deduction of traditional IRA. The only important requirement for a IRA contribution is that you can put in money into IRA only and only if you have earned income. You cannot do IRA contribution if you do not have earned income. Earned income in the sense you should have income from W-2 or salary. You should have income from any 1099 as an independent contractor or as a locum or as moonlighting income. Those are earned income. The salaries, the 1099s, the independent contractor, the locum, the moonlighting, these incomes are earned income. And only if you have these earned incomes can you do IRA contribution. If you do not have earned income, but all your income is from portfolio income. Portfolio income is income from interest, dividend, capital gains. Or if you have only passive income from rental properties and all those investment incomes. If you only have interest, dividend, capital gain, rental properties, investment incomes, passive incomes, those incomes do not allow you to put money into IRA. So for IRA, you need to have earned income, which is W-2, salary, independent contractor, locum, moonlighting, that kind of income. Then only you can put money into IRA. So again, you can put $6,000. If you're 50 years or older, you can put $7,000. This is traditional we are talking about. So you can get a deduction today, but you will have to pay tax in retirement. There is no income limits. Everybody can do traditional IRA contribution, but up to certain limits, it is deductible. After certain income limits, it is non-deductible. It might still make sense. I'll explain that to you. And the last thing is to do IRA contribution, you have to have earned income. If you do not have earned income, you cannot do IRA contribution. Okay. The second type of individual retirement account is a Roth IRA. Roth IRA, again, the limits are same, $6,000, but if you are 50 or older, you can do 1,000 extra up to $7,000. But whenever I use the word Roth, you know what it means. It means that in a Roth, you do not get a deduction today when you do the contribution. You would not get a deduction today when you do the contribution, but then at the same time, when this contribution grows for so many years and becomes a huge number in retirement, and you start withdrawing the money in retirement, even at that time, you would not have to pay any taxes. That is Roth. You do not get a deduction today, but then the amounts that you withdraw in retirement, those amounts also are not subject to any taxes at that time. If you remember, we discussed in the last video, who would opt to do a Roth? Roth should be done by taxpayers who think that they are in a lower bracket today, so they do not need that kind of a deduction, but they anticipate that they will be in a higher bracket in retirement, and that's why they want to do Roth, so they do not have to pay high taxes in retirement. So that is where Roth comes into picture. Roth is a good tool, is a very nice tool for the reasons and for the people that I just mentioned, and I mentioned in the last video. But not everybody can do Roth. Once your income is $129,000 per year, if you're a single, and your income reaches $204,000 if you're married, once your income reaches to that $129,000 or $204,000, then the Roth contribution starts phasing out. You cannot do the whole 6,000 or 7,000, and beyond those income limits, you will be limited and you won't be able to do the full amount of Roth. Okay, so Roth is a good feature for the reasons I mentioned, but not everybody can do Roth. One of the good features of Roth is also that whatever you contribute to the Roth accounts, you can withdraw it even before you're 59 and a half years old without any occurrence of penalties. So remember, in the last video I told you, or even we discussed in this video initially, you should try not to withdraw your retirement money before you are 59 and a half years old. Otherwise, you could attract a 10% prepayment penalty. But with Roth, this is a special exception that whatever money you have withdrawn, you have deposited, not the growth, I'm not talking about the earnings. Whatever money you have contributed to the Roth accounts, you can withdraw before you're 59 and a half, and you might not have to pay any penalties, 10% pre-withdrawal penalties. This is a special feature for Roth IRA accounts. So we discussed traditional, we discussed Roth, and there is one more IRA. It is called spousal IRA. Again, the limits are same, 6,000 and 7,000. And spousal IRA can be done as traditional, where you get deduction today, but you will have to pay tax in retirement, or it can be Roth, where you do not get a deduction today, but then you do not have to pay taxes in retirement. And this 6,000 or 7,000 traditional or Roth, this can be done by the spouse. It can be done by the spouse if the other spouse has earned income. So if the other spouse has earned income, but the second spouse does not have earned income, even then the second spouse who does not have earned income, even they can do this IRA. That's why it is called spousal IRA. Spousal IRA allows the non-working spouse, the other spouse who does not have earned income, the non-working spouse, to accrue some retirement savings. So that is spousal IRA. Okay. So we discussed three IRAs: traditional IRA, Roth IRA, and spousal IRA. And there is one more feature that is not on the screen. Let me stop the share screen and talk to you on that. Okay. So there's one more feature, one more kind of IRA that is not discussed in those three IRAs. That is called as a backdoor IRA. Backdoor IRA. So what is backdoor IRA? So if you remember the traditional IRA, anybody can contribute. There is no income limits for doing traditional IRA. But then I mentioned that only some people with some income can get deduction. If you cross that income limits, you do not get a deduction. You can contribute to a traditional IRA, but you do not get a deduction. What you do is you contribute money into this non-deductible traditional IRA first. You contribute money to the non-deductible traditional IRA first. So you contribute the money, you do not get a deduction, okay? And then immediately, the same day, the next day, without any earnings being accrued in those accounts, before any earnings are accrued in those accounts, immediately you turn around and transfer the money from this non-deductible traditional IRA account into a Roth IRA account. Okay, that is backdoor IRA. So it's a two-step process. Step number one, your income is too high, but you can still contribute to a traditional IRA. You would not get a deduction. That's fine. It's a non-deductible contribution to a traditional IRA. And once you put that money into that account, immediately, same day, next day, within a day or two before it grows, you transfer this non-deductible traditional IRA account, all the money into a Roth IRA account, okay? and the money goes to the Roth IRA account. So this is a backdoor IRA where you transfer money to traditional first and then into Roth. Okay. Now, why would anybody do a backdoor IRA? You would do backdoor IRA because if your income is more than that $129,000 that I mentioned for Roth, or if your income as married couple is more than the $204,000 and you're not able to do Roth directly, this is this is a magnificent way of going into Roth IRA as a backdoor. So if your income is too high and you cannot contribute to Roth directly, this is how you do indirectly. Okay, couple of things. Number one, why would you do that? You would do that only if you think you're in a lower bracket today, but you will be in a higher bracket in retirement. That is when you want Roth. If you're in a lower bracket today, but you think you will be in a higher bracket in retirement, that is when you want to do Roth, number one. Number two, if you already have money in IRA accounts, if you already have money in traditional IRA accounts, simple IRA accounts, SEP IRA accounts, then the backdoor IRA might not be the best option for you. When you do these conversions, there is a rule called as pro rata rule, and that pro rata rule backfires if you already have other IRA accounts. So be very mindful. This is not one size fit all kind of a strategy. This might work for you, might not work for you. If you already have IRAs, simple IRAs, SEP IRAs, traditional IRAs, then backdoor IRA might not be the best option for you. Be mindful of that. Okay. So today we have discussed 3 individual retirement accounts, the traditional, the Roth, the spousal, and we also discussed the salient features of backdoor IRA, who should do it, how you should do it, and why you should not do it. I hope all this helps. In the next video, we will discuss 401k accounts. Okay, so I'll see you soon in the next video. Take care. Bye-bye.